Today sees the launch of our September bi-monthly report, focusing on trends and transactions in all sectors of the Irish commercial property market as the market gears up for the traditional autumn selling season. Several large transactions are currently being finalised, and a number of notable properties are expected to be launched for sale over the coming weeks, so a busy autumn is in prospect. Thankfully, to date, Brexit concerns appear to have had minimal impact on the Irish commercial property market, with values holding firm regardless. All sectors of the market, with the exception of the industrial and logistics market, which is compromised by a shortage of modern accommodation, are clearly on target to achieve good volumes of transaction activity for the remainder of the year. And prime rents continue to increase across all sectors, albeit at a slower pace than that witnessed in the earlier part of the year. One of the most notable trends, which has become very much in evidence during the summer months, has been an increase in planning and development activity in the Irish market, with several new schemes applying for and obtaining planning across a range of different sectors. Securing funding for these schemes will now be vital to their deliverability, and an increase in forward funding activity is expected. In the office sector, there was some slowdown in terms of the volume of office leasing activity concluded in Dublin during the traditional quieter months of July and August, which is normal for the time of year. However, a number of transactions have signed or are due to sign during Q3, which will provide a welcome boost to the almost 90,000 square metres of take-up recorded in the first half of 2016. We could therefore potentially see annual volumes of take-up in the capital matching the record volumes achieved in 2015. Demand for office accommodation has continued unabated during the summer months, buoyed by continued employment generation in the Irish economy. Indeed, employment in Ireland exceeded 2 million people for the first time since 2009 during July, with more than 56,000 jobs having been created in the last 12 months alone. Much of this is office-based employment. There has been an increase in the number of inquiries from potential occupiers looking at the feasibility of locating some operations in Dublin following the surprise Brexit referendum result on the 23rd of June. Most of these inquiries are still quite preliminary, scoping exercises, with any increase in transactional activity emanating purely as a result of Brexit unlikely to materialise in the short term. Potential occupiers are comforted by the visibility on future office supply in the capital, considering the number of office schemes that are either under construction or at various stages of the planning process and which can be delivered if required. The onus is now on government to ensure that Dublin has sufficient housing and other necessary infrastructure to facilitate any increase in occupier demand that may materialise as a result of Brexit in due course. In this regard, we would also urge government to review personal taxation rates, which threaten our competitive position when pitching against other European capitals for office location decisions. There is now more than 378,000 square metres of new office stock under construction in the city centre, of which only about 1/5 is due for completion in 2016, and 44% of which has already been pre-let. This in turn will put further upward pressure on rental values in the medium term. At present, prime headline rents remain stable at €57 per 50 per square foot, although it is expected that prime headline rents will shortly breach the €60 per square foot, which is now being quoted on a number of prime schemes. Occupiers that are in a position to sign pre-lettings will potentially have the opportunity to secure more favourable rental terms. In the industrial sector, less than 120,000 square metres of take-up was recorded in the Dublin market in the first half of the year, which is down by more than a third in terms of the volume of take-up achieved in 2015. It is important to point out, however, that this disappointing volume of transactional activity is reflective of a severe shortage of modern stock in core locations, as opposed to a weakening in demand for industrial and logistics accommodation. Demand for modern stock actually remains quite strong across a range of different sectors, although industrial occupiers that mainly trade with the UK have understandably put some decisions on hold recently until such time as there is more clarity on the long-term implications of Brexit. Some occupiers that are involved in import and export businesses have been particularly affected by the weakening of sterling over recent months, and this is likely to continue to impact on activity in this sector over the coming months. Until such time as prime headline rents rise to a point where new industrial development is viable, we expect supply in this sector to remain constrained, with only a small number of developers tentatively proceeding with speculative development at present. Prime industrial rents are stable at approximately €85 per square metre and remain on target to reach our forecast of €94 per square metre by year end. Over the last few years, there has been a severe scarcity of industrial investments being offered for sale, despite healthy investor appetite for such properties, particularly those let on long leases. Supply has improved a little of late, with a number of industrial investments transacting in recent months, albeit most of these transactions have been relatively small. Recent transactional evidence suggests that prime industrial yields in Dublin are now in the order of 5.5%. There has been continued activity in the Irish retail sector over the summer months, despite a shortage of stock in some prime high streets and schemes, which continues to frustrate potential occupiers. To date, Irish consumers don't appear to have been curtailed spending in the aftermath of June's surprise Brexit referendum result, although there has been a noticeable increase in cross-border shopping in some border towns over the last 2 months as a direct result of the weakening in sterling that has materialised as a result of the Brexit vote. On the planning front, there's been considerable activity in the last few months, with the most notable announcement being the granting of planning permission for a large extension at Liffey Valley Shopping Centre in West Dublin, which will include Ireland's first Olympic-size ice rink. On Grafton Street, the well-known BT2 store has now closed, making way for a Brown Thomas pop-up shop that will operate until Victoria's Secret start fitting out their first Irish store in that unit later this year. Meanwhile, there's much excitement about the opening of And Other Stories, which is due to commence trading on the street in the coming months, and also around the imminent opening of IKEA in Carrickmines on the south side of the city shortly. Prime headline rents in Dublin remain stable as we enter the autumn season, and we're increasingly seeing evidence of rents improving in provincial locations, as evidenced by the most recent MSCI or IPD Irish Index for Q2. There's been particularly strong demand for premises in Cork of late, which is leading to reduction in vacancy on many of this city's prime streets, with particular demand from food and beverage retailers. In Dublin city centre, there's concern about the disruption that the ongoing light rail works may have on footfall patterns as retailers gear up for what will be their busiest trading period in the run-up to Christmas. The Irish investment market has been active of late. According to the latest MSCI report, total returns in the market increased by more than 3% in the second quarter, with rolling annual returns to the mid-year point having moderated somewhat to approximately 19.5%. The fact that 10-year bond yields have declined in the aftermath of the Brexit referendum result has actually made investment in Irish commercial real estate more attractive, on the basis that prime property yields have remained steady and the arbitrage between bond yields and property yields is even more compelling than it was in the early part of the year. To date, Brexit has had no discernible impact on the appetite for Irish commercial property investments. If anything, it has boosted the volume of inquiries for prime real estate, with several euro-denominated funds having increased their capital allocations of late. Pricing remained steady at the start of September, although, as previously indicated, investors are becoming increasingly focused on core assets, which may lead to a softening in pricing for secondary assets in the Irish market as the year progresses. The most sizable asset currently being marketed is Liffey Valley Shopping Centre in West Dublin, which is guiding in excess of €600 million. As the autumn selling season kicks off, a number of investment properties are due to be launched for sale. However, as has been the trend for much of 2016, much of the underlying investment activity will occur off-market. With a shortage of core office stock to satisfy the volume of investor appetite at present, and less deleveraging now occurring, the focus for autumn will be on securing product for sale, both on and off-market. Given the lack of core office investment opportunities and the scarcity of debt financing, we expect to see an increase in forward funding transactions and also increased appetite for alternative sectors such as purpose-built residential schemes, student accommodation, which are generally less prone to cyclical fluctuations. Severe supply shortages in some sectors of the Irish property market have become even more pressing on the back of the recent release of the provisional results of the 2016 Census of Population, and also on back of the prospect of additional investment coming from the UK in due course as a result of the Brexit vote. This has further focused government attention on the need to deliver infrastructure and in particular housing. Although the volume of new home delivery in Ireland in the first half of the year was up 18% year on year, only 6,600 housing units were developed, of which only 1,900 approximately were developed in Dublin. An increase in the delivery of new housing stock should be facilitated by the implementation of the government's blueprint for the housing sector, their action plan for housing, which was formally launched during the summer. With new development plans recently published for both Dublin City Council and Dún Laoghaire-Rathdown County Council, and also some further incentives to promote house building anticipated in the forthcoming budget in October, the expectation is that viability will improve and developers will have confidence to proceed with the much needed development that's required, leading to a visible increase in output from this point forward. In particular, we expect to see an increase in the development of build-to-rent residential schemes and purpose-built student accommodation. While transactional activity slowed a little in some sectors of the property market during the traditional summer season, there has been consistent activity in the development land sector throughout the summer months. The majority of the land sales completed during the summer have been relatively small lot sizes, with a notable exception being the sale to the state of approximately 5,000 acres at Glenasmole on the Dublin-Wicklow border in recent weeks. Many of the transactions that are underway at present are being conducted off-market, and this is likely to continue to be a trend for the remainder of the year. However, with many investors now focusing on development and forward funding opportunities considering the severe shortages that are existing in some sectors of the property market, we are anticipating a busy autumn in the development sector of the market. A number of very significant hotel transactions proceeded to final exclusivity stage in recent weeks, including Dublin's famous Gresham Hotel and the Doubletree by Hilton on Burlington Road. Other sales that have concluded during the summer include the Radisson Farnham Estate in Cavan for approximately 26 million and the Lyrath Hotel in Kilkenny for well in excess of the guide price of €20 million. More than €400 million of Irish hotel transactions are due to sign over the coming months, and it now looks assured that last year's record level of transactional activity of over €700 million will be matched, if not exceeded, in 2016. Investor confidence in the Irish hotel market remains strong, despite Brexit, and we continue to see new entrants to the sector, especially from the Eurozone. We're also seeing an increase in demand from global investors who trade in dollars or are headquartered or based in the US. Several of these have successfully bid on some of the assets that have either sold or gone sale agreed recently in the Dublin market. However, many of the properties that are due to be launched for sale over the coming weeks are provincial hotels, and it will be interesting to see the profile of buyers that emerge for these assets. Planning activity has also been brisk over the summer in the hotel sector, with several new planning applications for hotel developments and extensions lodged, and also a number of projects being granted planning permission over the last few weeks and months. One of the most noteworthy, which has the potential to be a significant boost for Irish tourism, is the decision by On Board Pleanála to grant planning permission on a 395-acre site for a Centre Parks holiday village in County Longford. As many as 1,000 new hotel bedrooms will be under construction in Dublin by year end, which is encouraging. Considering the severe shortage of hotel rooms in the capital, it is frustrating to see so many proposals to provide much needed hotels being appealed by third parties and in some cases being refused planning permission. The implementation by Fáilte Ireland last month of new regulations that, among other measures, significantly reduce previous minimum bedroom sizes for hotel bedrooms will improve the viability of hotel development, and it is also expected to boost appetite from budget hotel operators. This may see some hotel projects that have already had the benefit of planning permission going back for revised planning. At this juncture, it's too early to measure what the impact of June's unexpected Brexit referendum result will have on the Irish hotel and tourism sector. However, on the basis that this sector is highly reliant on demand from the UK and Northern Ireland, visitor numbers from these areas is likely to slow on the back of recent sterling weakness. It is therefore very important that the government shows continued support for the hotel sector by retaining the 9% VAT in the forthcoming budget. Encouragingly, and despite the Brexit result, the latest forecasts from STR predict continued improvement in occupancy, RevPAR and average room rates in the Dublin hotel sector over the next 3 years. Transactional activity in the pub sector was quite subdued during the summer, following the sale of 13 Dublin pubs, totalling almost €18 million between them in the first half of the year. This is partly due to the time of year, but it's also influenced by the scarcity of good quality premises being offered for sale at present. Many publicans are now working with new debt providers. Trade has improved, with the result that there's less pressure to bring these pub properties to the market than previously. As the autumn selling season commences, the biggest challenge in the Dublin pub sector will be a severe shortage of supply of good quality premises to match the strength of prevailing demand.